Okay, well, what we're going to do right now is we're going to take a quick walkthrough of basically underwriting two different tranches of equity. Sometimes an investor has enough capital to purchase the property themselves. Sometimes, though, they don't. And so, though, what the investor will do, or the syndicator may, is bring on another investor into the deal. Now, what we're going to do is I'm going to walk you through here very briefly these multiple equity tranches that we're going to underwrite. Now, the buckets that we need to underwrite are, excuse me, I'll mark this up here, time zero, right, our equity in. What sometimes an investor will do and a syndicator is maybe the syndicator puts up 25% of the money at the very front end of the deal, and the investor puts up 75. It could be a 90-10. It could be an 80-20. It could be a 40-60. It could be a 37-63. Whatever you work out. All right, so that's the first bucket. The first tranche is T sub 0. The second bucket that we're going to split out or tranche is before tax cash flow from operations. In this particular deal structure, the syndicator is going to get 30% of the operating cash flows, and the investor is going to get 70% of the operating cash flows. Okay, so that's bucket number 2. Bucket number 3 is simply the before tax cash flow from reversion. And we said in this particular example that the syndicator would get 25% of that net cash flow from reversion, and the investor would get 75% of that. So as you can see, all of these are always going to equal or should equal 100%. Okay? So this in a nutshell is what to tranche out for this particular example. Okay? Now, what we're going to do is we're going to take a look at the actual deal structure, the actual spreadsheet that we put together for this particular hypothetical example called vegetable circle. What we said, excuse me, is that the property is going to be purchased for around $3 million. Okay, around $3 million. The gross potential rent is anticipated to grow some. We have an operating ratio. Expenses are to grow in some way. So in any event, all we want to do first and foremost is reconstruct the operating statement. Okay, now we're used to this. This should be something that you can do with one head tied behind your back. But what we want to do then is, in this particular example, we said that the investor is going to get what's called a preferred return. And so what we want to do is we want to reconstruct the operating statement. We're going to hold this property for 5 years. Mark, how do we know it's 5? Well, because we've taken our net operating income here out to year 6. So at the end of year 5, what the buyer is going to do is they're going to buy year 6's NOI. In this particular example, we also said that there was some hypothetical annual debt service in the aggregate of $200,000. Therefore, our before tax cash flow is all programmed out. And then from that, what we're going to do is we're going to deduct any of the preferred return that's going to be paid to the investor. Now, a preferred return is essentially think of it as like an inducement to get the investor to unpark their money from here and park it in your deal. So in this instance, this investor is going to get a 10% preferred return, 10% based on whatever equity amount that they are going to put into the deal. We said in the fact pattern that the required equity is going to be 90% from the investor and 10% from the syndicator. Okay, so we need $1.042 million in change to close this deal. The investor is going to put in $938,000 and change, which is 90% of the 1.042, and a syndicator is going to put in 10% of that required equity. So 10% of 1.042 million is 104,000 and change. Okay, so this is the going in equity here. We also said that when we sell the deal, that the investor is going to get 75% of that net cash flow at reversion, and the syndicator is going to get 25% of that. Okay, so here is bucket 1, the equity in. Here is bucket 2, the before tax cash flows, right? We're going to pay them a pref based on the required equity out of the available cash flow for distribution. And then at the back end of the deal, the investor is going to get 75% of this, and the syndicator will keep 25%. So there are our 3 buckets. Okay. Now, what we're going to do is we're basically going to run then 2 different internal rates of return scenarios. Right? Here's the first one, and here's the second one. The first one relates to the equity investor. We said that their required equity up front is the $938,250, so we drop that in here, of course, as a negative number because it's a cash outflow for the investor. They're going to write us a check for $938,250 in order to close this deal. We, as the syndicator, are only going to put up $104,000 and change. Okay? Now, these preferred returns then that we're going to pay to the investor get dropped down here into their IRR calculation. Okay, so this is just the pref over the 5 years. That pref is based on their initial equity. Okay? And then at the end of the deal, the investor is going to get the 75% of this net, which equates to about $4.3 million right here. Okay? So here are the investor cash flows. All right here. And then this is the investor IRR. Okay. Now, we've partitioned this, which is fine. You should know how to do that. This is basically an 80-20 for the investor. Not bad. Pretty okay. And then here to the syndicator. The syndicator is essentially the person who finds the deal and packages it up and then kind of sells it into the investor. So the syndicator is going to put in $104,000, right, which is 10% of our required equity in. And then what's going to happen here is that the syndicator, based on this programming, is going to keep all remaining cash flow for distribution over and above what we've already paid to the investor. The investor is going to get their pref first. Then we, as the syndicator, are going to get the difference. Now, does this always mean that the syndicator is going to get the difference? No, not necessarily. You can parse this out that maybe the syndicator only gets 10% of the available cash flow to kind of keep the ball rolling, keep the lights on, etc., the phone on. And then maybe the balance of that is going to go into the account here, and then maybe that's going to be distributed at the end. But in this particular example, we just said, okay, well, whatever is remaining after the pref has been paid to the investor is going to go to the syndicator, right? So this is going to be the difference in the available cash flow. The syndicator puts in 104. They're going to get 1.4 million here at the end, as we've already programmed here. So therefore, the syndicator's IRR is an 87.33 with basically a 40-60 here, 60-40. So this is very well balanced with a very attractive internal rate of return. And we know that the syndicator in this example is going to make essentially twice as much IRR because they're not really putting much into the deal in the first place. But they're also getting almost as much in pref here, or available cash flow for the operating cash flows, as did the equity investor. Okay, so right here we have a 41.67 and an 87.33. My friends, this is essentially how to underwrite multiple tranches of equity. We have the investor and we have the syndicator. So there you have it. I'm hopeful that's helpful to you.